Hey everyone, welcome back to the weekly market recap. Today we're breaking down what happened in the markets for the week ending July 13th, 2025. We've got fresh highs in the stock market, some surprising job numbers, and key headlines you do not want to miss. Whether you're new to investing or just want to stay updated, I'll make it simple and clear. I'm Tyler, the Student Outreach Coordinator of the RMHS Investing Club.
I'm Ted, one of the co-founders of RMHS Investing Club.
I'm Luke. I'm a director of strategic initiatives and club photographer.
This week, markets posted gains led by small cap and value stock. Now let's break down what each index measures and why it moved, starting with the Russell 2000, which tracks 2,000 small cap US companies. It jumped 3.58%, driven by stronger domestic economic data, especially the rise in JOLTS job openings and modest payroll growth, which supports smaller companies that tend to be more sensitive to the US economy. Moving to large cap space, the Dow Jones, which covers 30 large established US companies, rose 2.34% as investors rotated into blue chip stocks, partly because recession fears eased after improving PMI data. Next, focusing on value stocks, the the Russell 1000, which focuses on large cap US value stocks like banks and industrial, gained 2.03%, supported by higher interest rates that help financial stocks and by stronger economic data that benefits sectors. Looking at the broader US market, the S&P 500, the benchmark of 500 US companies climbed 1.75%, driven by overall optimism about the economic resilience and steady job growth. Turning to growth in tech, the Nasdaq, heavy in technology and growth stocks, it was up 1.63%. Despite slightly higher rates, tech held up thanks to continued consumer demand and positive earning momentums. Outside the US, the MSCI Emerging Markets measures equities in developing countries. It edged up 0.45% as global risk sentiments improved and the US dollar weakened slightly, which supports emerging market assets. Finally, the MSCI EAFE covers developed markets outside the US and Canada, mainly Europe and Japan. It was flat at 0.06% as modest gains in Europe were offset by softer economic data in Japan. In short, solid economic data helped small caps and value stocks lead the week, while large caps and tech still delivered steady gains on strong fundamentals.
Next, here's how major sectors move this week, what each one represents, and why. Materials were up 3.8%. This sector includes companies in metals, mining, chemicals, and construction materials. It rose stronger manufacturing PMI and rising prices for copper and silver boosted demand expectations. Financials were up 2.5%. Covers banks, insurers, and asset managers. Gains from higher long-term interest rates, which helps banks' profit margins, and stronger economic data suggesting steady loan demand. Technology was up 1.8%, includes software, semiconductors, and hardware firms. It moved higher on continued investor optimism and about innovation, AI spending, and a stable consumer demand for tech products. Industrials were up 1.2%, which made up machinery, airlines, transportation, and logistics. Improved services and manufacturing data lifted outlooks for industrial activities. Communication services are up 0.6%. This contains media, internet platforms, and telecom companies. It posted small gains as ad spending trends stayed steady, but was held back by some profit taking after recent rallies. And healthcare was down 0.1%. Includes pharmaceutical firms, biotech, and health service providers. Slightly down as investors rotated money into more economically sensitive sectors following the upbeat in PMI data. In short, sectors most tied to economic growth and global demand this week led this week's gains, while defensive sectors like healthcare were flat to slightly negative.
All right, now we're going to dive into what's coming up this week in the stock market and the economy. This week is packed with big events that can shake up the markets from major company earnings reports to crucial inflation data and even more government policy updates. These are like the heartbeat of the economy, that tell us how healthy things are and what might happen next. Starting Monday, some of the biggest banks like JP Morgan, Chase, and Citigroup will release their earning reports. Earnings are basically how much money these companies made or lost over the last few months. And you might ask, like, why does this matter? And it matters because banks reflect the health of the economy. If banks report strong earnings, it usually means people and businesses are borrowing, spending, and investing. These are all good signs for growth. Then in the midweek, tech and healthcare giants like Netflix and Johnson and Johnson will share their results. These companies tell us about consumer demand and innovation, which are big drivers for stock prices. On Wednesday and Thursday, we get important inflation numbers, the CPI or the Consumer Price Index, and the PPI or the Producer Price Index. Why watch inflation, you might ask? Because when prices rise too fast, the Federal Reserve often steps in by raising interest rates to cool things down. Higher rates can make borrowing more expensive and slow the economy, which can also push stock prices down. This week's inflation reports will tell us if prices are still climbing or if they're finally starting to slow. The Fed's meeting minutes come out Wednesday as well. This gives us a clue about what they're thinking about for interest rates. Are they likely to cut rates soon, or will they hold steady because inflation isn't under control yet? Investors pay close attention because Fed policy directly impacts the cost of borrowing, mortgage rates, and even the strength of the US dollar. Also, despite some risks like ongoing tariff tensions and a tight labor market, the stock market has been hitting record highs lately. This shows that investors are optimistic but cautious. We also get job data and consumer sentiment reports later this week. These tell us if people feel confident about spending money and if companies are hiring. Remember, some experts warn of possible market corrections if inflation stays high or if consumer spending slows down. So it's smart to say diversified. This means, or that means spreading your investments across different industries to reduce risk.
Want to learn more about investing or personal finance? You can check us out at our website at rmhsinvestingclub.com, or you can visit us at our TikTok or Instagram where we post accessible tips and announcements for our club. Remember to take control of your finances, y'all.